A lot has happened in global and local markets for the first half of 2019. Now that we have entered the second half of the year, please join us to find out where markets are headed and how you can strategically position your investment portfolios for the second half of the year. I'm Santi, and today we are joined by ATRAM's Head of Multi-Asset Strategies, Sandra Araullo-Gonzalez, who is responsible for the management of multi-asset portfolios for both individual and institutional accounts. It's great to have you, Sandra.
Thank you for having me.
We saw muted Philippine economic growth in the first quarter of the year. Do you anticipate stronger second half GDP growth despite the budget delay in the first quarter of 2019?
So the short answer is yes. We do expect stronger growth numbers to come in the second half of the year. It's really, aside from the budget impasse that we saw in the first quarter, you also had some slowdown in export demand. So we've seen improving numbers on the export side, and that bolsters our view that stronger GDP prints are to be expected in the second half. That said, perhaps an average of 6% growth is what we expect for the whole year.
So what are the tailwinds and headwinds for the Philippine stock market for the remainder of 2019?
So we really saw a lot of improvement on the macro fundamentals. Clearly, inflation has come down from high levels that we saw in 2018, third quarter 2018. You also now are seeing more reasonable valuations in terms of price to earnings. So we're around 17 times, and when in 2013, when we got our investment grade rating from a credit rating agency, we saw a revaluation of the market from around these levels, 16, 17 to 21 times. So today we're actually at 2 notches above investment grade, and because of improving macro fundamentals, growth is there, inflation is benign. There's no reason to expect for market valuations to move back up to the higher range, 21%. Also, corporate earnings are expected in the low teens this year. So, it's really quite favorable for Philippine equity investors to stay in the market, and those who have not yet put money in is to add or to start taking equity risk. Oh, so those are the tailwinds. As for headwinds, actually it's more external in nature. There's the slowing global growth, which is really a function now of your overhang on trade uncertainty. And you can't, because of an integrated global market, if your situation in US, China isn't going well, then naturally markets like the Philippines will still be affected. So it's that push and pull between local considerations, macro and market, and your global investment environment.
And what do you think the BSP's response will be to inflation decelerating?
So we all know the BSP governor is pro-growth, and because inflation is not a threat anymore, then we expect rate cuts from the central bank, which is actually all but assured by the governor.
What investment strategy do you employ, given the abundance of external risks such as trade wars and global growth slowdowns?
So the heart of multi-asset investing is really to harness the power of diversification. So the more asset classes you can invest in, the more sources of return you can add to your portfolio, the more insulated you are against different kinds of risks. So there are the external risks, and there are also risks in the local markets. You have concentration risk, for example, or even EM risk, because if things really turn badly, the idea is to really basically not put all of your eggs in one basket, to not have it all in Philippine equities or just in fixed income. But despite the the risks and the global investments, there are still spots we can take. Our strategy now is to pick our spots, pick our exposures on where risk is going to come from. So we like Philippine equity risk, a little less on the global equity risk side, but we also like to have that dollar exposure. Our view is for a bit of weakness due to structural considerations. So when that plays out, having global assets in your portfolio can help improve your risk-return ratio for your portfolio.
Okay, now you mentioned a dollar peso, right?
Yeah.
So what is your short-term end 2019 target for the dollar?
Okay, that's a bit of that's a contentious question because structurally we believe that the fundamentally the peso should weaken. You have government that is spending on infrastructure building. You have a current account and budget deficit, so it supports a weaker peso. You have a dovish central bank. But then in the short term, we've seen improving export numbers. Oil prices are subdued. You have, which is keeping your current account in check. And so we saw strengthening in the peso. The peso closed around 52.30 in 2018. So at first we said, okay, maybe year-end around 54 for the peso. But because of this short-term strength that we're seeing now and the momentum behind that, if you're gonna ask me what the year-end close would be, naturally you have to adjust that expectation lower. We broke through key resistance levels, and all those technical considerations can push your peso to kind of to a strengthening bias. So around 52.50 is where we see it at year-end.
And what external risks do you think will weigh on global equities?
Well, there's obviously the concern about trade talks between the US and China. It's been driving a lot of headline risk. So we think that rising geopolitical confrontation is really now the biggest risk to the global expansion rather than traditional late cycle dynamics in the US. And then the other risk that we're looking at is on inflation. So global investors have gotten used to very, very low inflation. And in that case, you know, it's where central banks can be accommodative and kind of stimulate the markets when growth isn't quite there. But what happens if you have risk of rising inflation because the prices go higher on less efficient global trading? So while it's not an immediate risk, it is a risk when nobody's looking at it. And we think that the balance of risks on global inflation are more two-way than a lot of investors are expecting it to be. Yeah.
Now, given the current scenario, what should investors do? How would you recommend clients position their portfolios?
In the current environment, we like Philippine equities versus, or I should say, we want to pick our risk exposures. And we still like equities, but we like local equity markets or Philippine equities more than we do global equity markets. Within global equities, we prefer the US because they're in the late cycle and normally you're able to squeeze more returns from equity markets even during the late cycle. That said, we're balancing it with an underweight on the asset class in general because you know, we'd rather put more money in local equities where we're more confident about the fundamentals, we're more confident about a possible re-rating in terms of valuations. And on the fixed income side, Philippine bonds are still the income from Philippine bonds are still very attractive relative to everywhere else in the world. And as Filipino investors, it's a high hurdle or it's difficult to compete with 5-6% yield. And so we still would put the core position in fixed income. Now we also pick our risk exposures on the asset class. So because the BSP is dovish, as rates adjust or as the market adjusts or prices in central bank dovishness, then we might switch on and off where we go to higher interest rate exposure, higher duration. Also, global fixed income, even if there's not much income to be had, it's a good asset to use to balance out the risks. Again, if things go bad, you have an anchor in your developed market bonds that will help cushion a lot of the underperformance. So a multi-asset approach might not give you the eye-watering 30% returns that you'll get maybe from Philippine equity markets, but you also won't be down more than, 5%. On a bad year, on a really, really bad, last year was bad. Both Philippine fixed income and Philippine equity markets were negative, and our global multi-asset strategies were, down 2%. So I think it's during the bad times when the value really comes in. And in today's environment, it's uncertain. It's quite uncertain. So you don't want to put all your eggs in one basket. Yeah.
Okay. So just to recap, regarding equities, we like to choose our spaces of risk.
Yeah.
We prefer local equities over global equities, but to keep that diversification within global equities, we like the US.
Yeah. That's true.
And of course, we can't forget the fixed income portion within a multi-asset portfolio. In this space, we like the local bonds.
Yeah.
Because of their income in a low yield environment.
Yeah.
And lastly, regarding global fixed income, you want specifically developed market government bonds.
Yeah.
Government securities. Because if things go bad, you have that cushion to protect your downside.
Exactly. Yeah.
Thank you for joining us, Sandra, and for giving us insights for the remainder of the year.
Yeah, my pleasure.
I hope you are now more comfortable navigating the markets. For investment updates and expert advice, trust only ATRAM. If you have found this video helpful, please like and share.